Thank you very much, Casey. So I'd like to start by introducing our two panelists and kind of getting a bit of their background. So anybody who's started their career in finance has definitely pulled some numbers from a product that Bill was key in starting at S&P and then has now been at Blackstone for many years. And then Eric through Addepar, but before that, Palantir has a very interesting take on asset management as well as building software businesses. And I think both of those will be very interesting and comparative insights into how a new manager might manage capital over the next few cycles. And so we heard in the last panel about how companies are continuing to stay private, how portfolios are increasingly needing to be managed because the exits maybe aren't happening or people want more balanced outcomes in what they're doing. And so what I guess I wanted to start with is, Bill, you have some perspectives on starting out right? If you were going to build an asset manager today, whether that's a 50 million fund or a 500 million fund or a 50 billion fund, what are some of the things people should be doing and thinking about?
Sure. I think generally it's been like the cobbler's kids have no shoes in this industry in terms of even the VCs who invest in tech don't use tech themselves. And I think we're seeing a major shift in that. You have to be thinking about it up front, because if you do that, you save yourself a ton of pain later on. It also gives you the ability to use data science, use analytics, use other ways of measuring your business. And Excel, shouldn't really be the only thing that people use. And frankly, that's still what happens, I think, in most firms. We just happen to hit Blackstone's 400 billion and across a lot of different investing cases. So we just hit a complexity level probably sooner than everybody else, but I think it's something that everyone needs to think about, is setting up that infrastructure and setting up the technology to make it easy in order to be, add value in a repeated basis. And then the last thing just to throw in is a lot of what they talked about in terms of first round and otherwise in terms of creating a platform, that platform to add value to your companies is enabled by good technology and good operations and infrastructure. So the more that you can think about that up front, it enables them to have a reach far in excess of their 100 employees or our 2,000 employees. You need to set up those systems early on.
And Blackstone is a huge firm, has had a lot of ability to build its own technology infrastructure. Eric, your company manages almost $1 trillion of AUM on the platform now, it seems. Most of that is everywhere from wealth managers to massive sovereign funds. What are some of the insights? The world of software is software trickles down. So what is the preserve of a very small, very large asset manager today could be the preserve of a smaller person tomorrow. And so what are some of those thoughts you might have?
Right, yeah, so piggybacking off what Bill was saying, many of our clients are family offices, independent wealth management firms, as well as banks. And so Addepar isn't managing the capital, but we are providing a technology platform really to help each one of our clients understand the details of each of the investments they've made and allow them a much more data-driven way to understand, of course, their performance and what's driving that performance, as well as where they're carrying risk that maybe they didn't really understand before. And so using technology in the right ways, technology, for the sake of technology is no good for anybody, but really understanding technology with a specific purpose in mind, and as Bill mentioned, kind of across the clients who we serve, we do see them embracing technology and the foundation that good technology and good operations bring to bear to much more scalably deploy capital, understand the outcomes of that capital, and really use that to inform additional bets that they want to make, whether they're doubling down on an investment, whether they're trying to free up liquidity because there's an opportunity that presents. Really, but in all the cases, it's just making sure that within the firm, they're able to align what basically for every functional role within the company, they're all looking at one source of truth, they're looking at the same data, and therefore they're able to run the firm in a much more clean way.
Yeah, I mean, sometimes we always talk about technology, but it's really technology and data, and even maybe we should say data and technology, because the data is way more important in terms of having that focus down to each individual at the firm, and how are they going to be great stewards of your infrastructure, including every piece of data that they are responsible for. And most people do not have that kind of long-term thinking baked into their day-to-day, so you got to create systems to try to help them keep it clean, management reporting, investor reporting, everything driven off that same source of truth that that you're relying on for your day-to-day business.
And so, the last panel spoke about managing portfolio. This has been a year characterized with, things hopping out of, say, the venture ecosystem that people should have known maybe for many years in the past. A company can go bankrupt overnight, it seems. Yet there's so much data in the world. If a stock is going down, you're able to manage your risk. With more data and more knowledge, Bill, how do you think about a VC or a growth equity firm could manage their risk in a way perhaps that Blackstone manages risk, or a large bank manages risks? Do you think there's learnings there, or that's something that could be done better?
I think people are getting better at it. However, the world is disrupting faster than ever, so you've kind of got these two separate, it's the disruption is causing more risk at the same time when we're reading more data and analyzing it better. So it's sort of like trying to keep up more than actually closing the gap, I think. We feel like we're in a race about making sure that our platforms, in terms of how we help companies, how we really drive value, how we measure risk, continue to stay, as close to the lead as possible across all of our different asset classes. Because the minute you stop getting better is the minute people are passing you. There's really no way that you can just stop, and it's often a very seductive. And I still argue with people about this. It's just like everybody wants to do a project and then just stop. Well, as soon as we're done, it'll be finished. It's not like building a building. In terms of an ecosystem of data and technology, it's more just a continuous cycle of running a race and trying to stay towards the front, rather than thinking that there's some great finish line that now I can take a rest, unfortunately.
For sure. And with software and data, we can know more about our portfolio as well on a day-to-day basis. Your platform, Eric, helps people see up to the minute what's going on with their portfolio, whereas a lot of VC LPs have to wait sometimes 2 years before they get a nice, 200-page impenetrable LP presentation that's, to some of the points on the last panel, kind of marketing the next fund more than, giving a real picture. Do you think we will move into a world where software helps you see exactly what's going on in real time, or that's a product people would want, or what do you think?
Well, I think technology, especially in financial services, if it's built well, the technology itself kind of fades into the background, and you're helping people make better decisions. And so while it's true that in the context of a venture portfolio, maybe you're getting updates from portfolio companies monthly or quarterly or what have you, but you want to be able to ask smart questions anytime, and ask really data-driven questions anytime. And so ultimately what you want to be doing is deploying capital to people who are building something of value. And as you're noticing market conditions change and opportunities present and so forth, you want to be able to interactively ask questions of the data, of the companies and so forth, and have much more thoughtful discussions than with the portfolio companies and the investors. And so, sure, over time, as Bill was saying, the investment in technology is a continuous process. You're never done. But I think if you do it correctly, then the level of data-driven insights, where you're getting the right balance between what the technology is doing and what the people who are operating the technology are doing, and ultimately, if they're able to make more informed, investment decisions using that data, because you're helping them kind of broaden the search space of things they can look at, they're going to have better outcomes.
Yeah, the one other piece, and this is just very consistent across our entire LP base, is the type and the depth of the questions is only going up. So as you're starting a fund, like a key value add on top of returns, which are, especially for first-time, second-time funds, it's difficult to say with any type of certainty, right, what those are going to be. So you're selling a version of the future that everybody is trying to calibrate how likely that is. Well, in the interim, that information that's passed back is value add back to the LPs, and showing that credibility and the ability to do it easily is, I think, an easy way, a relatively low-cost way to start giving something back before your returns are even, taken over.
Yeah, I think there's generally a trend towards transparency in many, many industries, and technology is really enabling that to happen. And you can give it to people a lot more easily. A kind of externality of that a little bit has been everybody wants to be exposed to venture. They want to be exposed to technology, but some of the regulatory securities legislation is kind of almost 100 years old at some of this point, and it was based around preventing fraud, whereas nowadays it should be relatively easy to find out if someone is really doing what they say. What do you think in the regulatory landscape, Bill, for instance, might help change that, might not be needed? Where do you think the regulatory landscape moves from being an LP in a venture fund?
Yeah, I mean, I don't see any movement towards less, unfortunately. It would be great. No one likes to work on the regulation. However, at our firm, there are times when you look at it and you're like, wow, I'm glad we're so big because we can handle it and deal with it. And we still want to pound our heads against the wall sometimes when you're doing stuff that doesn't really pertain to, the spirit of what they're trying to accomplish doesn't line up with the letter of what's written down on the page, and that gap is the thing that's so frustrating to us. Unfortunately, there's not a lot of indications that the winds are going to change towards less, but we can all hope, I guess.
I agree with that by and large. I think one of the, if there is something encouraging, we've been to a couple different roundtable discussions in DC with some policymakers who are showing early signs of wanting to adopt technology a little bit more proactively to at least make it so the letter and the spirit of the law and the intention can potentially over time be tech enabled, so it's easier to comply with that. But I'm with Bill on this. I think it's super early days, and if there is any sort of progress on that that's meaningful, I'd be delightfully surprised.
All the more reason to think about your data and your technology early on, though, because if you do it, we're striving for this, and I don't think we're quite there yet, but we're getting there, is really having a data and regulatory workbench such that anytime a new regulation comes out, our goal is to, set up a report and a template and press go and have it handled. And I think it's not crazy to think that that's possible, especially at a small place. It's definitely possible if you craft everything with foresight.
So really it comes down to the system of records, or you can just start it in a much more expandable way, much like a software company does today, right? You can have different data assets. Do you think there's other, Eric, ways that a software company's growth or the way they harness things can inform a venture manager, in your opinion? Because you've helped build Palantir into the behemoth it is today, doing the same thing with Addepar now. Do you think there's much that a VC can learn? We have so many operators as VCs who probably know this, but also so many finance originators.
Yeah, I think, piggybacking off what Alan said in the previous panel, I think it really does start, from an investment standpoint, it starts with the entrepreneurs. So finding, people who know their market well, know what the opportunity is, can define a new category that's a sizable category, and have a strong point of view of how to dominate that. And so I agree with investors coaching entrepreneurs because there are many things that entrepreneurs are great at, and oftentimes managing details around cash flows and so in performance and whatnot. That's the level of detail that many entrepreneurs can use some coaching there, but not stifling the creative spirit that goes into building something that's really built to last. And so it is somewhat of a balancing act, and I think there are lots of inputs. I feel very privileged to have been part of a couple companies that have done quite well. And it's not coincidental that many of the investors who were aligned early on, first and foremost, shared the long-term vision we had for the company, and had a high degree of respect for the people around the table who were actually going to make that long-term vision achievable, and they recognized that it takes time. And it takes time to find the right talent, to make sure that you give that talent in an environment to really do their best work. You surround it with a culture so that all the things that I think many companies would love to have as ideals, best idea wins, meritocracy, and taking action and so forth, you can really live by that. And so what you're building, basically is a strong foundation that allows you to compound the innovations over time and not just kind of make little incremental progress that ultimately isn't going to go very far.
Well, one thing we've been trying to do is get the right mentors for our CEOs. So while they want, we don't want to stifle them, we also, our investors can help with certain things like cash flows and finance and everything that they're good, capital structure, so on. But making sure that we have the right industry folks to backstop them and give them the advice they need is like hugely valuable, and oftentimes not something that every individual CEO has like groomed over their career. They could be a very good operator, but they could not have that mentor or that coach that would really help them. So we've been focusing and trying to put executive chairmen and other types of industry veterans in for our different companies, and it's yielded a lot of fruit by giving that CEO the support they need, not necessarily smothering them, but doing it in a way that's just truly additive.
So really, we can have all the software in the world, but we really do need people helping people, which, funnily enough, conferences and software can also probably help with. Have you found that trend has been made easier by just communication being easier, that you can like build networks? Has there been kind of network effects of Blackstone where, a CEO runs something or someone's on the board of something? Right. And how does that expand?
We've had network effects, but they've been amazingly old school, which I guess would play into a bit of your thesis about this conference and otherwise. It's really been person to person. I know First Round has done something much more kind of platform and next generation-y, and I think that's a factor of the type of companies and the type of stage that those companies are at, where they've gotten uptake there. Whereas with our companies, we have, I think, 600, 700,000 employees across all of our different companies, and each one of them is a behemoth in and of itself. So we haven't gotten down to where that platform, automatic sharing, and that sort of thing is as fruitful as just kind of having communities at the different function levels and making sure people are talking when they have problems.
And to build off that a little bit, having Addepar straddle Silicon Valley and New York, I think one of the things that makes Silicon Valley particularly unique, and has been the case for a while, is you have a lot of entrepreneurial people, of course, like very high density of innovators, but they're really there to cheer each other on. And so it's more of an informal network where it's easy to reach out to, for me to reach out to other CEOs who are running companies that I admire, and just pick their brain on different things, and it's very commonplace. And so ultimately, it's bring up the entire industry, it's bring up the innovative spirit in that community. And now that I think that in New York, that scene is also, I think, growing and thriving. 15 years ago when I was an undergrad, I kept looking for Silicon Alley, and I couldn't find it for the life of me. But now that there's a proper community there, where there's the right level of investment, I think it's hit a critical mass, and I'm starting to observe the same types of things culturally, where companies are trying to help other companies win. And naturally, you're competing for talent and everything like that, but there is a lot of cooperation as well.
Yeah, when we started Capital IQ in '99, it was like light years different than it is today. I wish we could go back and have mentors and events like this and people to draw on, because we probably would have gotten there twice as fast for half as much if we hadn't made mistakes along the way. So I'm jealous of the current day entrepreneurs and everything they can lean back on.
So yeah, I think it's around 27th is where I'd put Silicon Alley in Manhattan, right around now. And so essentially, as you think, right, in the past, you would have loved a great experience at Capital IQ and having more people around the New York ecosystem and elsewhere. FinTech has emerged since then. How do you think managing capital will look different when we have this panel in 5 years and look back? Do you think there are structural changes that smart contracts will have, blockchain, that, just transparency, networks, deregulation, or do you think the enduring model that's worked since the 60s or 70s, will have a difference?
I think it'll be gradual, and I'm a skeptic on the ability to generate real change with blockchain on most industries that don't have somebody to really force the change, who's in the industry with power and you know and even if any of this accounting stuff just got easier and passed data back and forth, it doesn't give a fundamental change to the industry. It just makes it slightly easier. So we're looking at that as just a small enabler to be able to do things at lower cost. I think that the biggest trend is still more value add, more able to see around the corner, and giving tools to both the companies and the GPs themselves to be able to do that more effectively. That's the path. In 5 years, we'll just be talking about how we're all using data that much more, and we're trying to add that much more value to our companies. Really putting resources behind that, I think, more than we have in the past.
Yeah, I'd agree with that. I think a lot of the trends that are picking up now, I expect to continue. Where who gets the best deal flow is very much a function of actually who's adding value, not just with dollars, but with perspective, with experience, and so forth. Again, back to the entrepreneurs. And so, technology again is a tool for those people to evaluate different investment opportunities. But the people who are actually generating, building valuable companies and wanting to build the next thing. Wanting to find the capital from the right place, they talk, right? And so I think naturally that deal flow, I think over time is coming more substantively from who's going to add value, not just who's going to.
And who's going to add value over like a very long time horizon? Because if these hold periods continue to go up, it's not going to be about who can help you in the next 30 days. It's going to be, really more like getting married to somebody for a long period of time. So I think that's the opportunity to differentiate, is prove that you're going to be able to not just help them raise their initial capital or do 3 introductions tomorrow, but how are you going to sustain value add over a 5, 6, 10-year period?
So like everything else, the software is not going to remove the jobs. It's just going to make us better at what we're doing in fund management today. And we just need to make sure that we're harnessing it for the edge that it can provide to the entrepreneurs, which are the ultimate people that need to benefit from that.
Right. People who need people.
People need people.
They're the luckiest people.
Exactly.
In the world.
Exactly. Well, thank you both very much for your time. We only got one little pun in there, so good for the audience. All right. Thanks very much.
Thank you.
Thanks.